I am happy to be with the author of Invest Like the Best. Chris, it is really good to see you and have you back on the Author Hour podcast. I think about 5 years after your first appearance. So nice to see you, Chris.
That's right. Well, thank you, Travis. Very generous of you to invite me.
So it's been 5+ years now, and I know that one of the really the beliefs that you have about the industry that you're in, financial advising, is that financial industry was not set up for the end client in mind. And I'd love to hear more about your thoughts on that.
Oh boy. Yeah, that's a very good question. I could spend a long time just addressing that issue. Well, yeah, I mean, there's, I guess at one level, there's the fiat currency system that we're in rather than gold. And that's been a, a long story for about 5,000 years. So I won't get into that in particular. I think what exercises me in particular is that having been in this business for 42 years as a finance investment professional, I think that the standard of service the average investor gets from the industry is simply appalling. And so my passion is to do something about that. I guess my specialty is investment. And I think that what people get as investment advice is unacceptable. And, there is a solution which is so much better and provably so. But I think that as I've been in the industry for so long, I basically branched out into financial planning and then taxes. And, there are issues everywhere. There are different issues. But in general, there's a lot of mystery and misleading guidance, which is a long way from best practice. So, I've just started a Substack, which is Best Interest Wealth Management, to try and address that. I've become a comprehensive best practice wealth manager to try and address that too. But I guess the source of this, where where I have the strongest views, is on investing. And I guess we could go into that a little bit more, or anything you
Yeah,
want.
I'd love that. I know, my understanding is one of your concerns with the industry is that people are told that they have to choose. If you want high returns, you must choose high risk, and that you find those to be false choices. Is that correct?
Yeah, it's simply absurd and provably wrong. I have a chance. I even have a little chart here which shows it. If you take the S&P 500 and you pick a bull market, not difficult now. If you go from 1995 to the end of 2021, that's 27 years of a bull market in equities. And if you take the most volatile quintile and rebalance it for 27 years, and you compare it against the S&P 500 and the lowest volatility stocks in the S&P 500 and rebalance it for 27 years, and you look at the chart, the lowest volatility stocks outperform the high volatility stocks by double.
Wow.
Yeah. So,
How has the industry gotten that so wrong?
well, I think that, it's an evolution, and I guess the excitement is always about let's make money right now. And if you're in a bull market, then the high volatility stocks in general will perform better today, this week, this year, maybe. But what an investment advisor is supposed to be doing is compounding real purchasing power for the long term. Because I think the objective is that you will have wealth when you need it in retirement, when you don't have earned income. And so you should have a long-term perspective. And what people don't understand, and I've had arguments with people who claim to be the number one financial advisor in America for 3 consecutive years, that they don't understand compounding. Everybody thinks they understand compounding, but on examination, they don't, and provably so. And, whenever I come across it, I take people on. I just say, no, you're using this incorrectly and you're coming to a bad conclusion. And you're advising, you've got, 80,000 followers. They need to know that what you just posted is nonsense, provably so. So, but the real amazing thing about it is that once you cross that bridge and you realize what compounding is, how you do it, it's very, very precise as a term. It gives you 4 metrics, which you can get any day. So, you're, as an investor, you can look at it any day. So you have constant transparency and accountability about whether you are compounding and what rate you're compounding. And the result is you get a higher long-term return with significantly lower risk. Now, whenever I do a seminar and I say, is anybody here who would like to have a higher return with less risk? Everybody puts their hand up. Everybody. But when it comes to doing it, they just really, what? It's not that complicated. Okay, it's,
Is it that it's not like sexy and not there's not this immediacy that it's you're putting things into less risk and you're looking at a longer time horizon? Is that one of the things that makes it a powerful illusion to go the other direction, do you think?
it's behavior. Part 1 of my book is behavior. And as Benjamin Graham, who was Warren Buffett's mentor and teacher, says, and it's a quote in the beginning of the first chapter, is that the investor's worst enemy is almost certainly going to be himself.
Mm.
So what happens to most people is they say, oh, I'm investing. Oh, what do I want? I want a return. And so people start chasing returns and thinking a high return is the greatest thing in the short term. And what they can't distinguish between is what is luck and, where the skill is, and, what's going to happen over time. But it's everybody gets affected by that. I don't think our behavior and our brain system is naturally developed to be an investor making consistent decisions all the time. And so it's part of all of us, and all the best investors who I studied, they have to realize, okay, I'm my own worst enemy. I need a checklist. I need a framework, a mindset to deal with myself, because I'm going to have to manage myself.
I was wondering, is that has to be a really hard thing as an advisor too, because I imagine, like using that Ben Graham quote, I imagine that in times when the market is very volatile and the customer, the client is looking at their portfolio going down, you're the first person that they call, and you know that what they're requesting that you do, selling at that moment, is the worst possible thing that they could do. But also you're in a client management relationship where you need to, do what your client is asking for. But I would imagine there was a bit of a conflict though, because your ultimate goal is for their retirement, but their immediate goal conflicts with their long-term goal. Is that one of the burdens of being the financial manager?
Oh, definitely. Yes. And it's a constant issue, because people always want, oh, the market's going up, I must be rich, because that's how everybody else reacts. That's how everybody else is invested by Wall Street. And so they feel, oh, what's wrong here? And so, yeah, it is a problem, and it needs a huge amount of constant education and reinforcement. Every quarterly return, I say, this is what we're doing. And then, fortunately, I can show that over time, the drawdown is so limited that, I start at a higher level when the bounce comes and I get my share of the bounce. And over time, that hugely improves your compounding. And so you can demonstrate, over time that, any kind of benchmark can work. So, you have to be able to see both sides. So just again, in the first part of the book, I show the example of long-term capital management, John Meriwether, which was the biggest hedge fund.
My next question was going to be, are you a Merriweather or are you a Druckenmiller?
Oh, Dottenmiller, no question. Yeah, I was interviewed for partnership of long-term capital management in the
Oh,
90s.
wow.
We had a one-on-one with John Meriwether because I was managing director of proprietary trading JP Morgan at the time, and they were looking for someone to join their team. And it was 1997. It was like 4 years of 100% returns. And suddenly found myself in a room one-on-one with John Meriwether. So it's a fascinating discussion, but towards the end of the meeting, we just fell out because we just talked about risk and we said we just don't see things quite the same way. I didn't know their exact positions, but they were 30 times leverage. So they had like 4 billion in capital and 125 billion in positions. And so no surprise within a year. But, in 1997, he was master of the universe. You just have to say, well, we've got 6 Nobel Prize winning scientists. We've made 100% the last 4 years. And people say, how much money can I give you? That's the problem. People see the return. Oh my God, I want that.
Only when the tide goes out do you discover who's swimming naked.
Yeah, that's right. And, whereas in chapter 3, I show that a compounding method, which is probably middle school math, where you just do, a simple trend system. It's all explained in the book. You compare it to stocks, bonds, and gold. You do it for 40 years. And if you spend 5 minutes every month to do a little simple rebalance, which one's going up by that one, and that one in equal share, that one, other one gets junked because it's not in an uptrend. That's simple. And that beats stocks, bonds, and gold with less volatility over 40 years. So you had the 70s, you had the 80s, So you've been through all kinds of conditions, and the why we get to in sort of part 2 is because you are eliminating drawdowns, you are minimizing drawdowns. The number one factor in compounding is minimal drawdown. And some of the best investment researchers now, I don't know whether you've heard of Hedgeye, but they've just gone into asset management. I mean, the Hedgeye is just astonishingly good with their research. They advise about 10 trillion in assets now. And they're now going into asset management, and each of their ETFs that they come out with has a drawdown objective. They understand that, superior investing is, minimizing risk, maximizing compounding. And, without that clear objective about what is it that makes you a best investor, how do you allocate? How do you measure? If you're not doing all those things, you can't allocate and risk manage appropriately. So if you haven't got what compounding actually means you do, then you're just never going to be a best investor. You won't have the security, and you won't have the relentless outperformance that you get from compounding. I mean, compounding is actually the only metric which is the equivalent of your account value. So 20 years from now, what's the value of your account? It's defined by what you've compounded at. So an investment manager's job is to optimally manage the compounding rate, because it's the exact equivalent of what you're supposed to be doing. And if you don't have, if you're not managing drawdown, if you're not, you know, having consistency and safety, how do you plan? How can you in this passive investing, I'm wealthy today, but oops, market's down 50%, gonna have to have a different retirement. I mean, it's the risk to other people's money is horrendous in my view. It's irresponsible.
Back in the last author hour interview, you had you were a little critical or worried about the passive investing and the ETF boom. What is now 5 years in the future? What are you seeing now?
Exactly the same. See, the what people today is just the leverage, the positions, the confidence, the complete belief is like we've never seen. I mean, it's quite extraordinary. But when I mentioned to people that, well, actually, stock market peaked in 2000 relative to gold. So what's the big deal about stocks? I mean, how do you know what your return's going to be? I mean, the best trend has been in gold, and it's a low risk, and you haven't had 50% drawdowns, and you didn't have to do much. So I think people are very confused. It's if you want to your purchasing power in retirement, you've got to be monitoring what's the best asset. Stocks, everybody thinks, oh, you've got to be in stocks, right? End of story. No, the S&P 500 is 70% down relative to gold. So how do you feel now?
Wow.
And
Wow.
people don't even know that. Why isn't Wall Street telling them that? Wall Street doesn't want you to buy gold.
Why is that?
This, they don't get fees, You can do it on yourself, and you invest with them, and if you put your money in insurance investing, try and buy a commodity or have any commodities or gold in your investment annuity. You can't. I mean, I have never found it. I always ask that question, and they say, "Oh, well, maybe no, no." So it's scandalous that the average allocation to gold, even now, is something like 1-2%. If you add up all the ETFs, how much money is in there. So, I mean, people are ridiculously underinvested in commodities. I mean, commodities have had a very rough time. So you can understand why they've been abandoned in general, but not gold. I mean, and gold is an absolute cornerstone. If you understand what money and credit are, you have to have, you should, if you don't know what gold is, well, Ray Dalio said it. He said, if you don't own gold, you don't know the history or economics of it, and which is
Wow.
5,000 years old. And so, there are huge gaps in understanding and practice that I think are a scandal. And I'm terrified that, I look at 401k portfolios from time to time. It's just, you're losing money for 4 years and nobody's doing anything and thinking about it. I mean, the beneficiary doesn't really have a clue. It's just this, it's not acceptable way to treat people, I don't think.
There's lots of talk about Bitcoin being the digital gold. What are your thoughts on that?
Well, again, I go back to, well, the rules of money were established in Rome before Christ, and they haven't changed. And
I'm sorry, Chris. What are the rules of?
Well, at the end of the day, it's final settlement with nobody else involved. The credit basically involves a chain of people, institutions, whatever. In a chaotic situation, all the chains and trust and promises and guarantees and contracts disappear. Ultimately, the only thing you can be left with that is durable, that is valuable, according to ancient civilizations, but they haven't changed. I was recently in Turkey. I mean, everybody go to the Grand Bazaar. It's gold everywhere. It's flashing the gold price. India weddings. I mean, they know. And basically, there are certain conditions for what is really money and what is credit and what is currency. And Bitcoin just doesn't stack up because it's dependent on so many things. Is there electricity? I can't trade my Bitcoin. Or, is the jurisdiction you're in, does it have rules on Bitcoin? I mean, all kinds of issues with that. I mean, I'm not saying that Bitcoin doesn't have potentially a place in the financial system. I think ideologically, I think it's got many positive things, but it's certainly not money, and the volatility basically makes it impossible to regard as money. Yeah. So that's more or less what I think about Bitcoin.
Amazing. So back in 2021, you released your book. Can we flash back there? And what was your intention with the book originally? I know you had 40 plus years in the financial industry and you wanted to educate more people. I remember even back then, that was one of your life's works, was educating people on financial markets. What was your goal back then for the book?
Well, I guess I came into, I was in England, and I came to America for various reasons. I went into being an investment advisor from proprietary trader at JP Morgan, and I couldn't believe the investment advice that people had. So I thought, oh, this is good. I can do something different. But it's so different that people find it very difficult to understand, even if it is beneficial. And so I realized that instead of talking about it, it would probably make my life easier if I just wrote it all down. And then people would say, well, look at chapter 1, chapter 5, whatever. It's all there. It's timeless. It's, if you don't get this, you're to some degree, you're gambling. That's the way it is. And it helped in many ways. It was very cathartic for me, but also it just so reinforced my beliefs that I came out of that saying, look, I'm just going to produce, models or funds or whatever, which have higher returns with lower risk. And, 5 years later, it's going as it should, but it's a real struggle getting people to understand the benefit. I think with the passage of time, it gets, and I can show a longer period of time, it gets a little easier, but it is very difficult. That part 1, we just did a video with my son of part 1. We're trying to make it higher level, simpler, to get the idea across, because it's just so powerful. I think everybody needs to have better safety and higher long-term returns. So anyway, that's become my mission, as well as, increasing the better practice and across finance. So yeah, and so I've got a mission. I can't do anything else. That's for sure. So this is what I do.
And now you're producing content, you've got a newsletter, you've got videos that you're creating with your son, you've got a content engine going again. What is your purpose behind all that?
I just want to spread the word. I mean, it's good to have, it's good to have the right clients, because, not everybody is appropriate for this, I think, as I've discovered. But if a person isn't going to be my client, I think I can still help them in a certain way, because, this is so big. This is about other people's lives. And, I've got something here which I think is important. So I'm just going to keep at it and find a way to communicate better. And I think my son's helped a lot in that regard.
So this, if I'm understanding correctly, you were coming at the financial industry from a very different perspective. You had very concrete thoughts that you felt you could defend in a book. You created a book, and now this is allowing you to basically find the clients that are perfect for you because they understand your methodology, and it's a right mesh. So the book is acting as a lighthouse to attract those clients that you were looking to attract.
Yeah, that's right. It's the core of the whole story. I guess there are always new parts and elements and developments, and nothing stands still. But it is a core. It's a real prerequisite, I think. And if people want more wealth and security, I mean, I don't think there's a better way. So I feel the mission is good. It's positive contribution, and my son's got it, and a few people get it. But yeah, it is a different way of thinking. So it's very behavioral, and we're not designed to be good investors. So it is a natural challenge being good at investing. I have to control myself every day. So, but I've got, no, don't do that. I've got a checklist, because, we all have emotions, and we're not supposed to be emotional when we're investing. We're supposed to be clinical, objective, and what's the process here, and that. But, none of us are perfect either. So, yeah, it's definitely my North Star.
That's great. And man, to have a book on finance that's that timeless, where 5 years later you can still draw on it, you can still use it, you're still creating new videos, you're still educating people off of that original work, speaks to how great of a book you wrote.
Yeah, there are some things about finance which are very durable and very deep. Now, the techniques and the way the market trades and that's evolves every day. I mean, there are new approaches and new ideas and new developments and but more science and what have you. And you have to keep up with that because it's a different animal than it used to be, and it's not going to stop changing. So there are things, but if they're not grounded in these elements, then you're at risk. You're at risk in ways you may not understand. So you need to have like the foundation, and apply it to the whole chain. So you've got the whole story right and secure. And if you don't have that investment objective really clear in your mind, you're not making consistent and good decisions. And, the foundations are really important for whatever else you do.
What I would love to, since I have a world renowned expert, if you'll humor me, I want you to point out the error in my thinking. The way I've looked at my investing, I was a big fan of Jack Bogle from Vanguard. And I loved when he talked about, I'm probably butchering the quote, but he said, he was talking about compounding fees of investment advisors. And I think he said, the magic of compound interest gets overwhelmed by the tyranny of compounding fees, and that the American people don't know that is a shame for them, or something to that effect. So I've basically put most of my money in VOO, the S&P 500 ETF, and my other bet is on things that I believed I had an information advantage in. Not that I'm on an insider in these, but for instance, I've had Tesla vehicles for 10 years. I've loved them. And because I loved them, and because I knew that my experience with them, the public really didn't understand. They didn't understand how great the technology was. I put, probably 10, 20% of my money into those things. But I'm talking, and I've done nothing in gold. And I'm starting to think that I have a huge blind spot here. So what am I getting wrong here? And please be brutally honest.
Well, I'm not necessarily saying wrong. I mean, but I think it's suboptimal. That is the issue in terms of low risk and high return. Now, we've had the most extraordinary bull market in history, and we're still in it. But I think people need to understand that first of all, the stock market peaked against gold in 2000. So this is a fiat money environment where manipulation and debt and liquidity and all kinds manner of things are engaged in the value of financial assets, and the interests of politicians and Wall Street and are, a bull market is good for all of us. may not be good for people who don't own assets. So the vested interests are simply extraordinary. However, one has to appreciate that because something has worked really well. I would say it's worked pretty well since 2009, just being long equities in dollar terms. And one has to understand the mechanism about how you got there. And, increasingly what is happening and it's going crazy this year this is not because we're seeing naturally derived profits emerging out of these
Right.
companies. What we're seeing is spectacular deficit spending from the government and the corporate sector, which looks like profits because that spending becomes profits somewhere. But the leverage is frightening. I just saw the banks lending to margin brokerage accounts has gone vertical. We've got circular financing by Nvidia supported by Wall Street today, 500 billion. So, I mean, this is what happened in 2000, where you started seeing basically sellers of the mechanics of technology lending money to their buyers, their customers, and hoping that the customers would be solvent. So, there are so many remarkable things going on. Now, if you look at the Buffett indicators, for example, you just take GDP, which is inflated by astonishing spending already, but the stock market has gone to, I think it's well over twice the size of the entire capitalization of the stock market. If you were returned to the highs of the 70s, in other words, you would get a relationship but the highs of the 1970s and between the stock market and GDP, stock market's got to go down 65%. So
Wow.
and JP Morgan brought out this thing, given this valuation, what's the 10-year expected return on the stock market? And, it's the R squared on that relationship on the data they had for 50 or 100 years was like 99%. The expected return on the stock market for the next 10 years in nominal terms is zero. So you're getting to, extraordinary situation where, the leverage, the industrial production in America hasn't moved since the last 20 years. It's a flat line. So the financialization, the debt, we've been doubling debt every 10 years. So it's now 40 trillion. So 10 years from now, it's going to be 80 trillion. And also we got to pay for Social Security because the funds run out and Medicare. And so how's the math work on the next 10 years? So, you can be passive if you want. Highest valuations, the most extraordinary. And it's not, I own some equities. I own equity. I have, a good allocation because the short-term indicators are still there. I mean, the deficit just for July was 460 billion for a month. I mean, and money supply is going up, liquidity, they don't want to raise interest rates, they're producing liquidity to buy yen. I mean, it's like, if you put a fire hose on, you're going to get some water. I mean, so
Right.
yeah, I'm not standing in the way of a fire hose, but that's, you've got to realize the extraordinary nature of where we are and the danger too. And, you can spend, 10 cents on some puts. Just, so you've got something there, understand where your drawdown is and you're not going to notice it. So, I think that's the problem. And certainly the passive thing, you could have bought the S&P 500 in 1965 and your real return for the next 30 years going to 1995 was zero. and you had a 75% drawdown during that period. So that's what passive investing can do for you too.
Wow. And that's because it's being, you're comparing to gold than
No,
fiat currency.
that's in dollars, isn't it? In just in dollars.
Wow.
So your real return in the S&P 500 can be zero for 30 years. It has been 1965 to, so, so this amount of leverage, this amount of weak, I mean, the debt, I wrote this blog just a month ago. We're already in recession. I mean, and not just the US, all G7. So it's the debt creating the spending, which shifts. And in fact, they're managing that way. That's the reason we haven't had a recession for so long, is because whenever they see the growth going down, they say, pump, spend, you know, because if they spend, it goes directly into GDP number, right? And so you don't get recessions anymore. Doesn't mean the economy is strong. It means you're spending extraordinary amounts. So this is the game that you're in. And this is actually how fiat currencies die. So, but, like I was born in Africa and my sister was born in Zimbabwe. And there was a time when I looked at the Zimbabwe stock exchange and I thought, holy smoke, it went up 2,000%. I thought, why didn't anybody tell me? And then I noticed, the currency went down 5,000%. Oh, right. So,
Right.
that's what happens when fiat currencies collapse. What do you think's starting to happen here? How many fiat currencies have ever survived? None.
None.
So, why are all of them? I mean, Japan is probably the basket case, right? That's creating the problems already.
What about there's the belief that the United States is different because we have control of our money supply and we are able to print more and we don't have to go to another authority. And then ultimately we have the powerful military behind us. Is that argument just silly?
It has become silly. Yeah, because the reason for that is even the central banks, the people who manage the world's fiat currency, they are selling US treasuries and they're buying gold. And they've been doing that for 5 years.
Wow.
So what does that tell you? So the holders of treasuries are now sellers. So the foreign holdings of treasuries have gone down. The foreign holdings of equities have gone up, but the treasuries are going down. And, Besant is obviously highly reactive to someone selling treasuries. I mean, Japan said, we're selling our treasuries. Thank you. He reacted very strongly and unfortunately they're playing king canute because if you look at Japan, they've intervened twice before recently and it lasts for about, a week, a month, 2 months. And then it's just back to where it was, unless they raise interest rates in Japan, it's just not going to stop the yen going down and the need for the Japanese to get their dollars back. So yeah, I mean, China and Russia are ready for a gold standard. They have it all prepared. This week, I heard that Africa is changing its currency to enable their own gold standard in Africa, which is going to be linked to China. So the money is already moving. There's no question about it.
Does US have any hope for readopting the gold standard?
Well, it's not in the power that be's interest to do so. I mean, the powers that be in America are having a party. And, Trump according to the Iranians, Trump has made $5 billion in his personal account in the first 2 years. So I think every action that is being taken so far, the idea that anyone's going to do something about the deficit, there just isn't the constituency and the power structure that is indicating sobriety of any kind. And at this point, the international investors, and I don't think the press covers this particularly well in the US, the international, they've very clearly already made up their mind. I mean, the sanctions, tariffs, confiscation, it's not attractive.
Mm, wow. Well, I could talk to you for a long time. My last couple questions here, one of them that I just love is we hear all of these unexpected great things that happened as the result of a book that you just could have never predicted. Do you have any stories that come to mind of the unexpected great things that happen as a result of your book?
Clarity and purpose. The great thing about buying, writing in general, and especially a book, is the depth and commitment that the words that you write. You slave over that thing, in my case, 18 months. And it just gives you a real sense of something very strong. You dig deep and you stay there and you have to commit it to, print or black and white and live by it. And so it focuses the mind in an incredible way. So I would say that's what I got most out of it. I didn't try and market it particularly, but probably going to start marketing it now, actually, more than I did at the launch. I was too exhausted after reading the book.
Yeah, well, I think also this book will be timeless, and I could see you being one of the people interviewed on the next The Big Short movie as, hey, this Chris was predicting this exact set of circumstances long ago and wrote about it in this book.
Yep, it's timeless. It's like cyclical. Whatever happens has already happened before. So yeah.
And my last question is anybody that is considering writing a book or is maybe, 10 or 20 years, looking back on you before you wrote a book, what would you tell that person that's considering writing a book on why they should?
Why they should? It's an interesting question. I think they should because they feel they have to. There's just something in them that they just really need to commit to. They're fascinated by it. It's something that may be misunderstood. It's something that you can only communicate by writing down every word. And I think it's a lot of hard work. So if you need to have a level of passion about it, I think if you have a passion for something you need to say, a book is a great thing to do.
Ah, that is a perfect way to end. Chris, thank you so much for joining me. And I hope we can do this again, and wishing you a lot of luck on your resurgence in the content generation game and restimulating some marketing here. Let us know how we can help. And thanks so much, Chris. I really appreciate
That
it.
was great, Travis. Thank you so much.